Welcome to segment 2 of show 16 of HipMojo. Now we're going to talk about VCs and why they don't invest in content. We talked about this a little bit last week. We didn't really get into it. Why do you think VCs shun content?
All right, I know you're going to have a lot more to say about this, if only because I oversimplify everything. I'm a glutton for brevity. But I think why VCs don't invest in content is an oversaturated marketplace. We kind of were hinting at this when we were talking about newspapers. There's content everywhere. It's really easy to produce and disseminate. It's very challenging to build an audience. And I think from an investor standpoint, that makes it a tougher call. One, why would you invest in a marketplace that's already so competitive? And two, how can you actually be certain that the specific product that you're investing in is going to be enough to outcompete, all the sharks or piranhas swimming out there?
Okay, so I'm going to run through very quickly 5 quick reasons why, because we get this question a lot, and it's funny. I get a lot of entrepreneurs emailing me saying, "Oh, you're a content guy. Do you want to invest in my content business?" And I'm like, "No, it's fine. I'm fully invested in content.
I have enough content.
It's fine. I get out. I sit on a couch. I get up. I got content falling out of my pants, so it's fine." One, I think it's because VCs, their backgrounds are in tech. So the media executives, they make a little bit of money, but it's not like they started companies and sold for $5 billion, then took that money, started a VC fund, and invested in content. It doesn't work like that. But in tech, a lot of the guys who were at the Intels and the Oracles and the Microsofts and the Googles, well, they got a lot of money because it was a different organizational structure, equity. They made money. They are now VCs. That's their comfort zone. None of them got content. Two, there is a perception, fair to some extent, that content is a hits business. It's not like you're going to basically write a software and then you could print 1 million copies of that, sell it, and then you upgrade it and you support it. With content, even I'm a content guy, but I'll say it. Look at Lorne Michaels. He leaves SNL. SNL goes in the toilet. He comes back. It has a renaissance. So you could argue that, a tech company, you could basically take Larry Page and Sergey Brin, bring them out in the shack and put a bullet in their head, God forbid, and you could still bring in an outsider to run Google. But I'm not sure that DreamWorks works if
I think
violent
Google is
imagery,
the worst example.
Okay,
maybe Facebook, but not Google.
I would say the opposite, but that's next week's show. I totally think it's the opposite.
All right, we'll argue that.
We'll argue. Well, we know what the segment next week is. 3 is this notion of defensibility and the IP. I think with open source software and cheap hardware, and the fact that you need $5,000 to build a kick-ass product now, I think tech is less defensive now than content. I think you can't duplicate the WatchMojo catalog in a weekend, but you can build a Facebook replica in a weekend. Doesn't mean you're going to grow it and distribute it. I get that. But I just think historically there's this concept that tech is more defensive and the IP is more airtight. But you look now that patents are handed out for jokes. There's lawsuits, so I'm just saying times have changed, and we're going to get on that, but I'm not sure VCs get that time has changed. 4 is this concept of scale. It's true, without a doubt, that you could scale tech distribution aggregation a lot easier than you could scale content. We've scaled content, production, and to some extent distribution, despite the odds. But now that I'm 6 years into video content and 12 years into content, including my previous gig, I get it, that it's just so much easier if you're a distributor. The problem, again, and everything has a caveat, the problem is in distribution, you have to be number 1 or number 2, to quote Jack Welch. In content, you just have to be good, and good is very subjective. 5, I think it's this irony of, if you're a content exec, and let's say you worked 15 years at a media company. Let's say you made serious coin, and you're sitting on $10 to $25 million. If you now say you want to invest, as a former content or media executive, you've been disrupted by tech projects. So you don't want to then go and invest in content because you've been around super premium content at a traditional media company. You're not going to say, I'm going to go and fund into a sort of newbie content company. You're going to say, what are the tech companies that destroyed my business? Yeah, I'm going to go fund those, right? So this is the reality. 5, I think, reasons why they just don't invest in content. But there is a little bit of a sort of silver lining, which is this. Right now, the VC industry is supposedly, if you ask even the best VCs, broken. And it's true, returns suck. For the amount of risk they take, returns suck. And a lot of it is we've got to pivot as VCs ourselves. But they're pivoting in the context of size. Saying instead of raising a $500 million fund and looking for 9 bombs that go nowhere and the one YouTube, 1.6 billion, or the one Skype, massive hit, they're realizing that they need to invest smaller funds like First Round Capital, Union Square Ventures, et cetera, et cetera. I'm going to throw it out there that say that there is also going to be a need to pivot, not all of them, some of them into content and media funds. To me, a VC fund that funds in digital media, that still means to them that we fund like ad platforms that touch on media. I do think, though, that there is going to be content, and two reasons. One, I think in the last year, AOL's bought 5min, Go Viral, Huffington Post, and TechCrunch, so all content or video related. Yes, some aggregation, but it's still content and video. Those are big exits. That's $500 million worth of exits, and the VCs have noticed. And two, YouTube signed, initially it was reported to be $100 million, but Mark Schuster, who's a VC who basically on a panel I was on, said it's $250 million that they've signed. That's a lot of money. So I think VCs have taken notice, and discussions I've had at conferences and in person privately, trust me, there are VCs that are setting up these content funds as we speak. They may not have the expertise, and I don't know how it's going to fare, but there's two things going on that touch on the content and video space. One is these VCs that are finally starting to set up these funds to look at content, and the second one are existing content companies that have been around for 5 to 10 years that are going to start to do some kind of roll-up. And that's actually the theme of my next article on TechCrunch, the video roll-up play. We're going to take a short break. I just like ranted on. We're going to take a short break, and we're going to come back with lightning round.